U.S. February CPI increased 2.4% year-on-year. Apparel prices, which are sensitive to tariff pressures, experienced the biggest jump since 2018. Apparel prices went up 1.3%. The 2.4% jump in CPI is before the recent surge in oil prices. This is the calm before the storm. Expect the rise in oil prices to show up in March. The constant rise in oil prices will complicate the inflation outlook. Whenever prices of gasoline and energy increase, transportations and shipping will get more expensive, and it usually will be passed down to consumer goods. Any sustained gain in crude prices can quickly show up in the overall inflation numbers. The Fed will very likely keep interest rates unchanged in their upcoming meeting this week. Before the recent rapid gain in oil prices, markets expected interest rate cut to be June. Now, expectations have been pushed to September, at a 59% chance, not a very high number. Then, there might be a second cut before the end of the year, but at a 43% chance. This shows that markets are expecting inflation to rise in the near term. Last year, Q4's GDP growth was revised downwards by a little because of adjustments to consumer and government spendings and exports. U.S. full-year GDP growth rate is now at 2.1%. 2024 came in at 2.8%. This really isn't a dire scenario. It's still relatively okay. After the Supreme Court struck down Trump's authority for IEEPA tariffs, Trump responded with Section 122, which will last 150 days. And now this is a new one, Section 301. Basically, this is an investigation in unfair trade practices. Trump launched this investigation in these countries on the right with the goal of replacing the reciprocal tariffs. This investigation will uncover a variety of unfair trading practices revolving mostly around manufacturing sectors. And it can be tariffs, it can be fees. The U.S. aims to bring the tariffs rate back to where the old rate is within the upcoming 5 months. Till date, there is no single flat total tariff rate, and nobody really knows the exact amount because it's complex. And there's a lot of areas that will experience different types of percentages. For example, just looking at this, steel will be 25%. Aluminium will be 10% to 25%. It's tricky to pinpoint an absolute figure for tariff rate, but this table gives a rough idea. The overall average tariff is about 10.5%, 10.2% to 10.5% at the last 2 rows, and it applies to entire U.S. import basket. Moving on to oil, the International Energy Agency will release 400 million barrels of oil. This is to help with the supply disruption triggered by Iran war. There's no definite timeline, but these reserves will be released over a time frame, and the 32 member countries will receive these backup supply of oil. Because of the disruption at the Strait of Hormuz, supply was reduced by 20%, and so the higher-income economies in Asia will now compete with Europe for cargoes. And liquefied natural gas is heavily used for electricity production, home heating, and obviously vehicles, automobiles. Look at the countries at the right. These are the members that will receive the backup supply of oil, predominantly Europe, North America, and Northeast Asia. Just a quick background. This 32-member IEA was founded in 1974 after the oil embargo imposed by Iraq producers because U.S. supported Israel during the 1973 Israeli war. IEA members currently hold more than 1.2 billion barrels of emergency oil stock, and there is a further 600 million of stocks as backup. The U.S. now allows 30 days of purchase of Russian oil to stabilize energy market. This will temporarily suspend Russia's sanctions. The U.S. also granted India 30 days waiver to buy Russian crude. There's about 124 million barrels of Russian origin oil across 30 locations globally, but that's only enough for about 1 week of supply. For some background, G7 and EU countries imposed sanctions on Russian oil after the invasion of Ukraine in 2022. Looking at these oil supply disruptions, there is one country that is very smart and has been actively preparing for bad weather days. And that's China. The surging oil prices will likely impact China much lesser than other countries because China has been building huge stockpiles of oil, and they've been spending years to diversify its energy sources, such as renewables, the greens, and they're also heavily pushing for more electric vehicles instead of internal combustion engine vehicles. Let's look at this first. U.S. is the world's largest consumer of oil, and you can see from the picture at the right. The second largest is China, followed by India, but the biggest buyer is not the US. The biggest buyer is China. They're the largest crude importer, and they've been buying nearly twice of what US is buying. Despite being the second largest consumer of oil, that means China may be less sensitive to prolonged closure of the Strait of Hormuz. They've been accumulating the world's largest strategic and commercial oil reserve. Furthermore, the rapid transition to electric vehicles and renewable energy. It's a structural hedge. It's estimated that China is holding about 1.2 billion barrels of crude as of January 2026. That's about 1/4 year of reserve, 3 to 4 months. China has been taking the past 20 years to reduce dependence on maritime oil flow, less dependent on oil imports by sea. And so now, China relies on the Strait of Hormuz for about 40% of its seaborne oil imports. And oil shipments through the strait accounts for only 6.6% of China's overall energy consumption. The remaining 90+% of China's energy consumption is supplied by other energy sources. This gives China a very strategic and unique position in global energy markets. You can see the huge difference in countries with 50-year-long plans. They stick to it and adjust and improve it, whereas, comparing to a country like the US, every few years, they'll have a new president. The new president always says that the plans from the previous one aren't good and comes up with a new plan. That's why it's different for China. When you have a long-term plan, you stick to it and think of preparing for the worst days. So far, Iran has sent about 12 million barrels of crude oil through the Strait of Hormuz, and satellite images showed it's mostly headed to China. You see two different numbers, and they're quite close. One says 11.7 million barrels, and other says 12 million barrels. And given that China has been the primary buyer of Iranian, could very likely a huge amount of those barrels is headed there. And China is staying neutral in the Iran war. In fact, they're trying to mediate. When asked for comments, China never really responded to the 12 million of barrels of crude oil going towards that. So in the first 2 months of this year, China accelerated the efforts in building oil stockpile. Currently, crude imports jumped by almost 16% year on year. On to UK overview, the second largest in Europe area. There's no growth month on month. Growth flatlined in January, and this is before the US-Iran war and the global energy price shock. What we can learn from the Russian-Ukraine war at its peak is many European countries' inflation jumped. They're very sensitive to energy prices, which is mostly generated by oil. This time around, more or less expect the same thing for European countries. But back onto UK, services sector usually is the strong one. But in January, it showed no growth. Production contracted a little, construction grew a little. The Iran war is driving concerns on inflation outlook. And like US, UK Central Bank's next meeting falls on the same week, March 19th, but there's almost no chance for interest rate cut this time. On to China. Consumer inflation recorded the biggest jump in more than 3 years. But for China, this is very good news because they're struggling with deflation. The headline CPI came in at 1.3% year on year, and looking at the core one, without food and energy prices, it jumped even higher at 1.8% year on year. What we can tell is inflation is mostly driven by services sector. Look at the bottom box at the right. Services sector is the primary driver of growth in China. So when service inflation picks up, that typically means demand is higher than supply, or the less optimistic one is, supply can be lower than demand. But anyway, everyone is hoping for more domestic demand in China. This is what they've been struggling with for years, ever since COVID. Many are hoping that inflation will stay on, and not a one-off because of Chinese New Year's sudden pickup in shopping and holiday season when suppliers go on leave and created the imbalance in supply and demand relationship. On to trade. Surplus hit the highest despite tensions with the US. So typically, China combines January and February together and take the average to smoothen the distortion from Lunar New Year holidays. Trade balance increased a lot, which means exporting more than importing. So that's good. Exports from China increased almost 22%. Imports increased almost 20%. And while trade with US dropped close to 17%, trade with EU climbed almost 20% and increased 20.3% with ASEAN countries. So again, this is the beauty of having a long-term plan and sticking to it. After IEEPA being struck down by the US Supreme Court, the US tariffs on China now is at 10%. Well, this is a little bit of a relief. But then don't forget we just covered the new Section 301 investigations, and some other tariffs still remain in place, like steel and aluminium. For those who must have a one number that covers all, China Briefing says that it is close to 30%. Retail sales increased, but not as high as last year's. Industrial output increased much higher than forecasted, and it stays a bright spot for China. Thanks to the resilient external demand, particularly from European and Southeast Asian countries, like what we saw at previous slide. So last one, investment in fixed assets. Fixed assets cover infrastructures, roads, buildings, machines, and real estate development. While the overall number increased 1.8% year on year, but zooming eye to real estate development, the decline is still there, the crisis is still dragging on. This time round, it dropped 11.1%, lower than the previous 2025 full-year number, 17.2%.